evening. We begin tonight with Iranian state media, which is reporting new explosions at two strategic port cities. There are images posted of damage at a fishing pier. No immediate information on casualties or the extent of the damage. A U.S. official has told us that the American military is not currently carrying out strikes. A regional official in Iran claims the U.S. hit several locations, including the perimeter of a nuclear power plant. And Iran also says it fired 10 missiles at a U.S. base in Jordan. A man said they were all intercepted. The renewed hostilities are having an immediate effect on U.S. gas prices. They posted their biggest one-day gain since early May after falling steadily for a month. So there you see, $2.98 February, $4.54, $3.84. Oil prices still remain low, or lower than the peak. The New York Federal Reserve President John Williams said he expects oil to come down even further. He said that would bode well for inflation. And the US investors seem to agree. The triple stack closed higher, led by tech stocks on the NASDAQ. Before we go to our next guest, go back to that last graphic if we can. I want to show oil prices, what they did. Oil prices, Brent and West Texas, they are down, even though hostilities are continuing. And if we look at the markets, they are up. And yet at the same time, the hostilities are continuing and threatening to get worse, with Donald Trump even suggesting that he thinks the ceasefire may be over. Geoffrey, you, senior market strategist at BNY for Europe, Middle East and Africa. It's counterintuitive, bordering on perverse, that markets are on a rally when the fighting continues and there's the threat of it getting worse. What's going on?
Evening. Well, the market is looking at different drivers right now, and even with the current situation, I think the view is oil prices are not really going to rise aggressively. Supply is adequate right now, and demand, we have to think about the demand side of things. That is soft. If you look at Chinese growth, for example, CPI coming at 1%, Chinese demand is weak, and that's a big marginal buyer of oil. So right now, putting everything together, markets are not too concerned about oil, not too concerned about inflation, and it really is just looking at the tech theme and everything else.
Put the tech scene to one side. We'll come to that in just a moment. When we got oil prices over 100 and above, the circumstances were pretty much the same as they are now. Now, admittedly, there was a ceasefire, but not much is getting through the Straits of Hormuz. So when you look at the situation, how fragile are those numbers? In other words, if the fighting got worse, would those numbers go much higher rather quickly?
So worse, I guess, how worse? Markets will ask that question. I think for the time being, if you look at oil futures curves and also volatility markets, they're not too concerned about things getting worse, but people are buying insurance through other asset classes. Let's be clear on that. If I look at bond markets, for example, there is much greater expectations being priced in for higher yields further down the line, or the risk of higher yields. That is adequate, but people feel they have enough insurance right now. If I look at break-even inflation, that's basically a measure of inflation expectations. They're 50, 75 basis points higher. It's adequate. Yeah.
Okay, so here's a toughie. Is the market fooling itself? Is it sort of on some rose-tinted, spectacled view on what happens? And actually, the truth is, if things got much worse, the whole thing could crumble quite fast.
So we're very used to looking at the broad market index, but here's where we just look below the source, as Sir Alex Ferguson used to say, and see what's underneath. And then we'll find that the breadth of what's driving markets right now perhaps is not that wide. So going back to that tech theme, those stocks are still doing very well, but the assets may be exposed to oil, not so much. So, not down significantly, but a bit more cautious.
Okay, so tech, which of course has been on the biggest tear known to man, so to speak. Tech, we've got the data centers needing to be built. We've got all sorts of issues of that. We've got valuations that don't make much sense. And yet we all seemingly know that this is the only game for the future in a way. And again, are we just suckering ourselves?
Well, you have to make certain assumptions about the future and the productivity gains and the like. But here's where we go back to the issue about inflation. Oil-driven inflation, less of an issue, but if it's tech-driven inflation or the data center investment, as you mentioned, and other aspects, power costs, for example, if that inflation surges before the disinflationary productivity gains come through, then maybe it's a bit more of a challenge, but we are not there yet. At least central banks are not that concerned yet.
If I were you, I would be putting that before that you just talked about, before the productivity gains in big bold letters, because there's an enormous amount riding on that productivity gains.
Certainly, and that's what's underpinning the valuations as well. But also you look at what future growth is and people are counting on that. But if there is anything to be concerned about or we're looking for at this point is beyond all the CapEx build out for AI and tech, we need other sources of growth right now. That's the challenge for governments.
Geoffrey, thank you. You made sense of it all for us and helped us understand what seems to be a rather perverse market in difficult days. Geoffrey, you're in London for us now.